Episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer millions of dollars of capital gains taxes, have a backup plan for a failing 1031 exchange so you can create and preserve more wealth. Each and every episode, we're joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we make complex tax deferral strategies simple and passive income plans achievable. And today's guest is no exception. He's originally from New Jersey. He's now in New York, and he's a real estate professional at Matthews Real Estate Investment Services, where he focuses on industrial investment sales in the Brooklyn, New York area. He's transacted over 35 deals and over $75 million. And he's focused on helping us get a good understanding of what's going on there in industrial and so much more. Please welcome to the show with me, Bobby Lawrence. Bobby, how we doing?
I'm good, Brett. Thanks for having me on. Recovering from a little bit of a head cold over this weekend, but excited for this show and excited to have a great week.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah. So I'll start with focus. I joined Matthews Real Estate Investment Services about 5 months ago now. And so me and a few of my former colleagues, from my previous company, came over to Matthews to build their New York presence. So how we're operating at Matthews is really as a group, and then we're overlaying a territory specialty with an asset specialty. So my territory, my territory is in the Brownstone, Southwest Brooklyn markets, and then my asset specialty is within industrial real estate. So we found, for example, Brett, if you owned a warehouse in Bushwick, you would be getting assigned two lead brokers, one of those being DJ Johnson, who's been working in that Bushwick market for 15 years and knows all the intricacies of each street in Bushwick, and then myself, who runs the industrial team. So people that are looking for industrial real estate in certain neighborhoods of Brooklyn are also looking in Bushwick. So we feel that's the best way to provide the most value for our clients. And so that's what I'm doing today, focusing really on industrial sales and land in Brooklyn. By way of background, I guess I could take that a lot of ways, but we'll start. I went to Colgate University in upstate New York. I graduated in 2014. I played lacrosse, which was obviously a huge part of my college experience. I really didn't know what I wanted to do after when I was in school. Actually, that's not necessarily true. Paul Massey, a New York City commercial real estate legend who started the notorious firm Massey Knackel, is a Colgate alum. So I actually tried to work for that company 2 times. I was tried to be an intern, didn't get the job, tried to be an associate after I graduated and didn't get the job. So I definitely had an interest in commercial real estate, but ultimately after the second time that I failed, I took the highest paying job I could get. So I worked at a sales and trading floor at Guggenheim Securities, staring at Excel sheets all day, was completely miserable, and realized I wanted to talk to people, interact with people, and wanted to get into sales. So from there, I pivoted into a real estate technology company that got acquired by CBRE. And finally, after that got acquired by CBRE, I cut my teeth at Marcus & Millichap, focusing in Brooklyn sales, really learned the business at Marcus, and eventually was able to work for Paul Massey. I transitioned to a company called B6 Real Estate, had 5 great years working with Paul Massey at B6. And then, as I mentioned, about 5 months ago, joined Matthews. So we're super excited.
That's awesome. Hey, it's a great background. Love the lacrosse background. Love the Marcus & Millichap background and everything else you're doing here. Before we dive into the topic at hand, which is exploring real estate opportunities, industrial Brooklyn real estate in particular, I want to take one other step back. Bobby, I believe you've all been given certain gifts, and these gifts have been given to us to be a blessing and help to others. Some people call them strengths, some people call them superpowers. I'm curious, what are those 1 or 2 strengths you believe you were given, and how does it help, how you help and bless people today?
Yeah, it's a great question. I think what people have told me is that I'm a good listener, and obviously in the brokerage business, that is super important. I think inherently I'm a good listener because I find people interesting. I generally find, what I love most about this job is that I can meet, I can go from a meeting to a private equity person to a second generation business owner to, XYZ ethnicity, especially within Brooklyn. And I really find all people interesting. And I think the key to that is just listening, understanding their problems, what they're going through, their motivations, and then from there being able to tailor their needs. I think younger brokers often are self-conscious of what they don't know, and so they try to fill that that anxiety with talking, giving data points, filling information, filling space. But being able to listen, I think, is truly a superpower in this business. And along with that, I would say, being okay with silence, being able to ask an open-ended question and let that sit there, because that's ultimately where you're going to be able to understand more about somebody else and not fill the space and really understand their motivations. And like I mentioned before, kind of tailor their motivations to what you think is best.
Absolutely love it. We're talking with Bobby Lawrence or Robert Lawrence. You can go to Matthews.com to learn more about him at Matthews.com, and he's focusing on industrial real estate. So, Bobby, let's dive right into the topic, which is that, what's the number one secret to really exploring and understanding the industrial Brooklyn real estate market right now, and or as a macro view, the last couple of years, and then we'll dive into more like what's happening here in 2024.
I would say industrial real estate in Brooklyn has been the most resilient asset class since COVID. So I think if you're an investor, it's really difficult, because I think to understand building wealth in industrial real estate, you have to understand the dynamics of New York City and Brooklyn in general. There's a supply and demand efficiency, because a lot of the warehouse product that existed before has been redeveloped into a higher and better use. So say a 6-unit condo or 6-unit high-end rental, if it's zoned residential, or there's been a lot of neighborhood rezonings. So like most recently, there was a Gowanus rezoning. And, throughout the past 10 to 15 years, there's been multiple rezonings where a lot of that industrial asset type has been redeveloped into residential. But with all that being said, there's still a ton of service businesses that still need to be in Brooklyn, close to New York City. And so there's a huge supply and demand imbalance. And so, for example, last year, there were 61 industrial transactions. 73% of those were under 5 million, and 84% of those were bought by users. So if I was talking to an investor today, what I would be saying is focus on larger deals, most likely above 10 million, where you could not have to compete against a user who's going to be able to price you out. Users usually pay 30 to 45% more than what an investor will pay for in today's market. And ultimately, what we see if you're an investor is, you want to buy the buildings that tenants find most attractive. So that's buildings with 20-foot clear in terms of the ceiling heights, access to major thoroughfares, access to subways for your employees, roll-up gates, curb cuts. And so those are the things, if I was looking at it from an investment perspective in terms of building wealth, I would say focus on bigger. And then obviously all those factors that I just mentioned, you want to make sure that are included in your building so you can find good tenants that pay good rent and always be able to fill that space.
Okay, let's dive into that a little bit here. So I think I hear you saying, so owner users are going to pay 30 to 40% more, which is a huge gap, right? Will you talk about the ability to get, owner occupied financing or SBA financing with that? And also what also adds to that? Because I would think, I think from an outside looking in, most of what we do is multifamily mobile home park, right? And where we're investing with our clients. But when I hear that 30 to 40% more, that's such a huge amount to overcome. So talk about how financing is playing the role in that, and what else is adding to that such huge gap between an investor versus owner user.
Yeah, I think the biggest thing is the supply and demand efficiency. So kind of what I talked about before is how a lot of this stuff has been, a lot of the industrial product has been redeveloped into residential, except there's service businesses that are very well capitalized in New York City that need more space and they don't want to lease. And a lot of these businesses have been around for a long time. So they kind of started, 30 plus years ago. They have an incredible amount of equity and they're able to tap into that equity and buy buildings all cash. On top of that, you're right. I mean, SBA financing is very favorable, and financing as a small business is more favorable than somebody looking at an investment perspective. So the dynamics of Brooklyn industrial real estate is that we've seen appreciation, especially sub 5 million, much faster than what we've seen for rents in industrial buildings. So I think those are why those are the kind of the crazy dynamics that are happening. And that's why, again, last year, it's a wild stat to really think about. 84, 86% were bought by users.
It kind of feels like these owner users have more to lose in the sense that they have 20, 30, 40 years of family legacy, family business, service, deep relationships, within that particular area or niche that they're doing, right? And they're serving. And for them not to own that, or for their competitor to come in and buy it, right? They have more to lose. Is that a fair summary too on this when it comes to that, Bobby?
Yeah. I think that's definitely a fair summary. I think what we're seeing is that businesses that have been here for a long time, they want brand recognition. They have a customer base that knows them in a certain location or a certain area. And again, if they want to continue to grow their business, usually they need more space. They need to have more materials in the neighborhood, or they need to have a bigger retail presence. And so all that really encompasses is that a massive user demand with a diminishing supply. And what you really see, I mean, my typical client is someone that's owned the building 30 plus years, little to no debt, probably still runs the business, most of the time still runs the business, and either they're getting old and want to retire, or the business has changed and their children never want the service-based kind of get your hands dirty business. And so then they're trying to figure out all their options. There's always partners involved, a 1031 exchange. And obviously, Brett, you know a ton about this stuff, but that's what I really enjoy the most is I'm often acting as a therapist, a friend, and a broker. Because usually it's never black and white. There's always a ton going on, and tailoring those best solutions I find really satisfying, and figuring out the best next steps is something I really enjoy about this kind of particular asset type and market dynamic.
Absolutely. Yeah. And I think that's so key, right? It's coming at it. I think that back to your original point of listening, right? The biggest thing I think when I was a young broker was the same exact thing, right? If you're not really listening, at the end of the day, we're not selling real estate. We're not selling tactical strategies. We're really just helping to solve people's problems. And if you're not listening to what the problems are, and the problems are unique to every single person, and it's going in with those assumptions that we already either know the answer or already know their problem, is where anyone can get ahead of themselves and really, not serve the client at a high level. And sometimes that means asking questions in such a way where it just gives them the space to think, reflect. And a lot of times, I think when clients are owning and building businesses in real estate for so many years, sometimes they don't even know. And that, I think, goes to the therapist part, right? Which is guiding and opening the opportunity for them to reflect on what it could mean if they are to sell, right? What is their legacy? Or of course, what are the implications for tax? What are the implications for cash flow? And what are the implications for family legacy? And these dynamics are massive right now. And we're going to touch on 1031 exchanges and different options and stuff coming up here. But I want to go a little bit more deeper into the industrial part of this. So you have the supply imbalance, right? Because a lot of these either been rezoned or for the residential crisis of, 4 to 5 million units short of affordable housing. And it get rezoned and they allow these things to build, but that just imbalances the industrial or more. Plus you have the rise of just services that are needed, right? And it just compounds the effort. I think industrial is also one of our favorites after mobile home park and multifamily for all the reasons that we're talking about. But you talked about the 10 million and above because the users are typically, let's say below that. So an investor has to, come up with more cash. How are you guys structuring these deals right now with financing being where they're at? And at what point do you feel like this imbalance is going to shift from cap rates actually making sense given the debt that you have to put on deals?
Yeah, no, that's a great question, Brett. To be honest, I'm not really making deals with investors right now. Because, as we discussed, the rents are not keeping up with appreciation. So if I have a bigger deal, even a deal, I sold a deal for $17 million and the top 5 people were still users. It was a healthcare facility, a yeshiva, a lumber company. And so even at $17 million, there's still enough well-capitalized users to kind of beat the market, where all the investors on that deal were really around 13 to 15 million. So I think what needs to happen, that what would probably stop that trend, unfortunately, is some sort of recession. a recession that affects these service-based businesses, where they aren't able to pay those premiums, those 30 to 45% premiums. And that would generally reset the market, in terms of that premium would go much lower. And I think a investor, all cash, able to close, good track record, will then have the upper hand on a lot of these deals to actually get some deals done. So, I mean, my belief is that right now is, a great industrial arbitrage opportunity, because a lot of the people that I meet with, or work with, again, they have a ton of equity in their building. They're often making less than a 3% return. If, let's say they have no debt, less than a 3% return on their property. And today, as well discussed, see it in the news, interest rates are high. I think triple net cap rates are as high as they've been in the past 15 years. Multifamily in New York City is as high as it's been probably since 2011. So what I'm telling people, if they are considering selling, making a move, is that it's an incredible opportunity to sell your industrial real estate to a user for a 2% return, 2 to 3% return, and be able to 1031 exchange into something that fits your lifestyle better. So whether that be a triple net property at a 6 and a 6.5 cap, or a multifamily property in Brooklyn, if that's what you're comfortable with, at 6.5 cap, 7 cap, sometimes even 7.5 cap, depending on where you're looking in Brooklyn. I think this opportunity will run out, right? I think the clock is ticking. Eventually rates will come down. And while your industrial property may still be, valued, and I don't see that going down anytime soon unless there's a big recession, I think your buying opportunity, you're not going to see these cap rates once we start to see some interest rate relief. So that's what I'm kind of preaching to anybody who will listen, who wants to sell. Again, if you don't want to sell, keep the property. But if you're considering it, I think it's a great time to understand your options.
Yeah, I couldn't agree with you more. We're talking with Bobby Lawrence with Matthews.com, exploring industrial Brooklyn real estate. Yeah, I like the way you said this, and what you're referring to is you just find the investor, right, and or the user who needs or wants to expand, right? And it's a great buying opportunity because debt is out of whack. And if you have a lot of equity that's pinned up, and you can buy either all cash, or you can put a higher down payment, or debt can be refinanced in a couple of years, and or if you're just a user, even better, right? Because you can get the SBA financing, perhaps even lower debt, although we have to look at that math. That makes a lot of sense, right? But the ROE is so important. And this creates a middle buying opportunity where it's a great time to actually transact for those that have the equity, either are the user or even the investor that's been holding onto that $5 million deal. They can get into a little bit bigger deal. All of that makes a lot of sense. Now let's
I'm actually talking more about the owner of these buildings who owned them for 30 plus years. I think it's an incredible opportunity to sell those buildings. If you are looking to sell, let's say you've owned the business for 30 plus years, the kids don't want it, and you want to retire. I think for that type of client, the market dynamics today make it incredible to sell, because on the sell side, as the business owner, I'm able to sell at a 30, 45% premium to another user. And if I'm renting it out, my return on equity is very low. I have a lot of equity built up in that property. And then on the buy side, if I do a 1031 exchange, again, as the business owner, because of where debt is today, I think there are incredible buying opportunities. So that's kind of what I was saying in terms of the arbitrage opportunity, but you're right as well. If you can buy all cash, and especially at a higher price point, and then kind of wait for rate relief, there's just not a lot of competition. So a lot of opportunities in any market. And I think, these market dynamics are interesting, and people are going to be making a lot of money.
Absolutely. Let's dive into what they do in the 1031 exchange, right? And over the years, we've done a lot of 1031 exchange with clients. But I'm curious, what would you find the biggest frustration is for a 1031 exchange for those that are selling, right? That you've come into, and then let's just talk about a few successful ones and what's really worked out for you and your clients.
I think the biggest hurdle with my clients in a 1031 exchange is figuring out what to buy. So at Matthews, we have Matthews Real Estate Investment Services started in 2015, and really it was built around retail and triple net property. So we have an incredible resource of triple net assets throughout the country. And oftentimes I present those assets to owners to see if it makes sense. And it takes some time to get people comfortable with, especially, again, the clients that I deal with that are very hands-on, and been in these neighborhoods for a long time, comfortable buying something out of state, buying something they don't really touch, less management intensive. It's hard to, like, it almost feels like as a broker, you're selling snake oil to them until you really like educate them on the opportunities. So kind of, that's probably the biggest challenge, is getting them comfortable with, one, selling their asset, and a lot of the times their identity is within that asset because they run their business, and then two, getting comfortable with the whole 1031 exchange process and what you're going to buy. But I've had a ton of success. Like, for example, I sold a warehouse in South Brooklyn. The person decided to sell because the tenant was leaving. Taxes were continuing to increase on the building. They weren't making any money, and the building needed a ton of work. So instead of putting, probably $400,000 worth of money to get that building back up to speed and rent it, again, this person inherited the building about 3 or 4 years ago. They decided to sell the building, and they bought a KFC in Kansas City. They doubled their income, no management, or decreased their management responsibilities. And those are the type of transactions where you find success. I've also just had people where they said, you know what, I really just want to enjoy life. I've been working incredibly hard for the past 30, 40 years, where they'll buy their dream home or a really nice condo where their kids are moving to in Florida, rent that condo out for 2 years, and then eventually live in it, and maybe pay some of the capital gains. So those are the type of situations that I often deal with.
Yeah, I love all of that. That all makes sense. I'm curious, connecting the dots on a couple other pieces here. And sometimes I feel like the broker industry misses this a little bit. By the way, I started out at Marcus and Millichap in 2006, helping people buy and sell multifamily properties. My background, I grew up in the real estate industry. So I love 1031 exchanges, but sometimes I feel like it doesn't solve some of the key things. And one of the biggest ones is estate tax, right? The death tax. Like, we've been taught the stepped up basis, drop until you swap, swap until you drop, and then kids get a stepped up basis, and you're tax free. Well, the rest of the story is your capital gains tax free, or the kids are, right? If it steps up, if they sell at that given time and it's the same price. But what they don't talk about is the estate tax or the death tax. And so some of these clients that have owned for 10, 20, 30, 40, 50 years, and if their estate is greater than 12 million married essentially as of 2026, or 6 million single, their kids are going to have to sell that asset within 6 months, or refinances, or do something to offset the 40% debt tax. And this is brutal, right? And so states like New York, New Jersey, California, it's a massive amount of appreciation for people who've built this. And now they're going to get crushed with the state tax. And the 1031 doesn't solve that. Number two, the 1031 exchange, you have the old depreciation schedule. So one of the best reasons to own real estate is to have the depreciation offset the cash flow. We call this tax flow, right? It's a beautiful thing. But guess what? Once you own industrial or retail for 39 years, it's fully depreciated. And or if you do a 1031 exchange, the old depreciation schedule travels. So although you might get a better cap rate and a better ROE, your ROT, your return on tax flow, is still lower, right? Because the old depreciation schedule traveled. And so you need a way to solve the death tax, and you need a way to get a new depreciation schedule while still being able to buy real estate. This is part of why we went all in with something called the Deferred Sales Trust, and helping people build what's called a capital gains tax exit plan that's beyond what we call the blockbuster 1031 exchange, and give them the Netflix Deferred Sales Trust, which gives them the ability to be retired, to be active, to get new depreciation schedule, to eliminate the estate tax. And sometimes, by the way, we get that saying, it seems like what you're selling, the snake oil, is too good to be true. And yet we just keep closing deals all across the country to help people understand what this thing is. But I'm curious, before this call or this podcast, had you ever heard of a deferred sales trust? Most people get it confused with the Delaware statutory trust, and they don't know the difference between the two. But have you heard of that before?
I was about to say, do you mean Delaware statutory trust? Because I'm obviously familiar with DSTs, but no, I've never been familiar with the deferred sales trusts. And I think it's definitely, like, I literally just had this conversation with an owner, 2 partners, one lives in Greece, he runs the business, and he decided not to sell because his kids will get a stepped up basis. But you're right, his estate is definitely worth more than $13 million. And that's something that I should be talking about with people, not necessarily as the expert, but more so introducing them to people like yourself. Yeah. to understand their options, because their kids who have no interest really in real estate will have to figure out something. And of course, depending on the debt situation of the portfolio, maybe you're able to sell off 2 assets and keep everything else. And again, it's really about understanding your options. But no, that's I was not aware of that.
Yeah, you picked up on it right there, right? And that's really like, what is the major problem? Like, again, back to the original thought, like if you're being great listeners, meanings, listening and finding out what the true problem is and making them aware of that problem. We were working with a gentleman, he's selling a $60 million business in Arizona. This is just a couple months ago. And he wasn't even aware of the death tax, right? And I don't know if you the show Yellowstone, right? Yellowstone is the whole concept of Kevin Costner with his land in Montana. That's the entire show. Hey, mom, like Beth, the daughter to the attorney, is like, Dad, you got to sell the land, because if you don't, you die. They're going to nail you with the death tax. Or B, you if you get the step up basis, they're going to get the death tax taken anyways, right? Or if they kill you, it's out. So we got to get it outside the taxable estate, like this whole thing. So to me, this is like one of the biggest kind of like fumbles of the commercial real estate industry, is not connecting these dots on this $84 trillion transfer that's happening over the next 20 years,
right,
and really bringing to light, like, what are the opportunities? And it also should be a compelling reason to sell, because if all you're ever saying is, look, let me find you that up leg that I promise is going to be a great fit, and all these, new toilets, new trash, new liability, new debt, all of these things, and let me line up that perfect puzzle piece to fit, versus, and that's just capital gains tax, versus let me solve the bigger issue for your legacy and for your wealth. And then number 2 is just the buy high, sell, buy higher 180 days later. Now, that can also be difficult, right? Where you have debt that's fixed at a lower interest rate, and now it may be fixed for a couple more years. So you have some certainty there. Like, it's hard to sell and remove, like, get rid of that debt and go into higher debt on a new deal, right? And so it's trading we call that debt flow, right? Like, right. It's not just cash flow, it's not just tax flow, it's also debt flow. We were spoiled for the last, before the last year and a half, for really 10 years, we were spoiled, right? And we just took debt for granted. It's always going to be low. Now that throws a whole wrench into a lot of these deals. And with the deferred sales trust, what's beautiful is you can be out of debt. You don't have to replace debt or equal greater value. You don't have to replace a property in purchase within the same time frame. There's no 45-day 180. You get a new depreciation schedule. Like, we wrote a book on this whole thing, and we try to like spread it across the broker industry. But it's kind of like old dogs, new tricks, right? Like, people are like, so I'm just curious. Like, when you hear this stuff, what comes to mind?
No, I mean, it sounds great. I think. But I guess, and I'm like in the position where I guess this is how my clients feel when I'm explaining a triple net property to them and never had any really experience understanding or working with or hearing about a triple net property. So I'm trying to process everything you're saying, which is interesting. But I think this kind of comes back to the point of why I think this job is so great. One, you learn all the time. You learn every day something new, and you learn from people that are really good in their field, whether that be the entrepreneurial who has run a successful business and now has a portfolio worth $50 million, or someone like yourself who's an expert in deferred sales trust and how to structure things and work it in the right way. So I think for me, it's just another quiver in my arrow to provide value and options to people. And I'm definitely of the camp where I was not thinking enough about estate tax. What I can say, though, is, again, given the industrial dynamics, a lot of the times it can make sense, again, just because you're selling at such a high price point to a user. You're really selling at a 4 cap, 3 cap, and then you're able to buy, again, in a triple net property like a 6 cap, or in multifamily New York City, a 7 cap. So that arbitrage opportunity still exists today, but of course you're right, especially for multifamily in New York City. If you are going to be doing that 1031 exchange, it's very much 6 cap to 6 cap, or maybe even like 6.5 cap to 6 cap, and you're really making a lifestyle change. So it's definitely something I should be more aware of, the deferred sales trust, and glad you brought it up. How would it work? So with like partners, so you're buying who's buying the real estate? So I sold my building. I'm now in the deferred sales trust. Let's say I have 2 partners and we decide to buy something else. I'm sure it's complicated, but like, what are from a 10,000 foot perspective, how does that look like? Or
Yeah, it's pretty simple, right? In fact, we just did a deal in San Diego. It was a $13 million exit, and there was actually 4 partners, and 3 of the partners decided to use the deferred sales trust. They had the majority ownership. One of them had like a 5%, so it was kind of too small. So he just paid his tax. Well, the other 3 were able to each have a trust and each customize their wealth plan and their investment plan, and defer the tax. Number one. Number 2, they're developers, right? So they buy land for about $500,000 to $1 million. They develop a car wash. That's their business for about $3 million. They're all in for 4, sold for 13. They're not in the business of buying car washes that are worth 13. They're in the business of developing the real estate, right? And so they need time on their side. And they need to be able to be entrepreneurial, meaning not only buy when they want to, but buy what they want to, right? And so that's their model. The second part of that is you can still go buy that KFC triple net deal with the trust. In fact, you partner with the trust in order to do this through a new LLC, which gives you a new depreciation schedule, the way we structure it. And so what actually happens is an installment sale. So you know it is seller carryback, right? Where someone has a $20 million industrial property for, say, free and clear in Brooklyn. They've owned it for 40 years, and a new buyer comes in and you say, look, your property's worth 40 million, but if you sell for 42 million, but you finance it and you sell or carry back, we'll give you 10 million down and you carry the other 32 million dollars, right?
Right.
Like that's called a seller carryback. We know about that. Now, once you get over those amounts, by the way, there's an interest charge, so we have a solution for that. But that's a traditional seller carryback. The challenge with that traditional seller carryback is that all of your equity is tied to that new buyer and that old property, which if you're selling it to begin with, the last thing you want to do is have to reclaim it or foreclose on it in a couple of years, to take it back and start all over again just when you get, done with retirement, ready to retire. So here's a solution. We use that same structure. However, we ask the buyer to come with cash. You can get a loan, come with cash, whatever. But we're going to have the seller sell to the trust first in exchange for a promissory note. We'll use 10 million as a simple example. $10 million deal, fully depreciated. 39 and a half years. So he has no basis left. And let's say he owns it free and clear. Instead of paying about 45% in tax there, about 4.5 million, he is going to now sell it to the trust on an installment sale at 100% seller carryback, and he'll get back the 10 million plus a rate of return of typically 7, 8, 9%. We'll talk about how we can collateralize the investment now in a second. And the trust sells it to the ultimate buyer. So it's the same simultaneous close typically. The trust bought and sold for the same price, Bobby, so it's no gain on the trust level. Right. The buyer took title the same way he would have. He's gone. He's happy. And the seller's left with a promissory note. He did an installment sale, right? Now, this is where the cool thing happens. He can immediately turn around and form an LLC, partner with the trust, and go buy, the KFC. But he gets a new depreciation schedule on that, right? Like, boom, versus the old one, right? But he can also buy that KFC or that apartment complex in 6 months, in 12 months, in 18 months. In other words, he doesn't have to do a 45-day 180. Okay, because he's no longer in the 1031 time frame. We call that the shotgun wedding. He's in an installment sales structure with the JV partnership, the way we structure it. And so, it is a little more complex. It does take a little bit of, getting used to riding the new bike, if you will. But it's actually taking an old installment sales structure, but combining it with a trust. Our role as a trustee, this is what we do here at Capital Gains Tax Solutions. We're kind of like a third-party qualified intermediary. And we're kind of like an IRA company. And essentially, we help to accommodate and work with the sellers of these assets to execute this with their brokers, right? And with whoever else is going to help them find deals. But this is why we fell in love with it, because it ultimately solves what they've been telling us. We hate to do a 1031 because we don't want to be forced to pay. We hate having to stay in debt because we have to stay in the debt replacement. We hate the old depreciation schedules. And by the way, we have this estate tax issue that we need to solve for. And so what's the solution to us? One of them, and I think it's the best one, is the deferred sales trust. This thing goes back close to 30 years, thousands of closes, been audited over 25 times by the IRS. No change, no findings, all perfect track record. And enough people just don't know about it.
Yeah. No, I mean, what I'm taking away from this, if I go into these situations, and especially as a broker, you don't want to be a commodity. You don't want to be transactional. You want to be able to provide resources to your clients, whether that be a debt broker, a QI, a triple net specialist, or now yourself, a deferred sales trust specialist. For me, this is, again, another resource that I can use for my clients to introduce them to someone like yourself and maybe have their accountant on the phone and be able to figure out if this is the best solution. Because I think ultimately that's the way to excel in brokerage. It's the way it's going, and to be the broker I want to be, you need to provide options to people. You can't just be transactional, and clearly, providing all the options is the best way to do it.
Yeah, you nailed it, right? So if people want to learn more about that, you go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. You can also look at the new book that we released with Kevin Harrington from Shark Tank. Pretty cool. It's called Building a Capital Gains
Awesome.
Exit Plan. Yeah. Hit number one bestseller. And it's my whole story from starting at Marcus and Millichap to doing side hustles at Cheesecake Factory when the '08 crash hit to now making it big in the Deferred Sales Trust, all these years later, since I learned about it in 2009. Just go to Amazon and check that out, Building a Capital Gains Tax Exit Plan. That being said, Bobby, running out of time. Are you ready for the lightning round?
Let's do it.
All right. Knowing what you know now, if you could go back to your 20-year-old self, what's the one golden nugget make sure to tell yourself to do?
20-year-old self. I'd probably put just horse blinders on, especially once I decided to commit to this business. During COVID, I kind of put my head up and was like, wow, nothing's happening. The world might be ending. Maybe I should do something else. But really, and everyone says that those are the times to double down. And unfortunately, I did stay in the business and been having some of my best years since. So I did a little early on. I kind of was always picking up my head, trying to figure out maybe I should do this, maybe I should do that. I would have been better served, especially younger, to commit to something, put the horse blinders on, stay focused, and committed to building a career in this business.
Amazing. Love it. What's the number one book you've recommended or gifted the most in the past year?
Number one book I've it's not a business book, but I love this book, Last Days of Night by Graham Moore. It's a historical fiction book about the race between Nikola Tesla, Thomas Edison, Paul Westinghouse on commercializing the light bulb. So it's a really, really good book. I think for New York City real estate, Risk Game by Francis Greenberger is a great book. Sam Zell, Am I Being Too Subtle, is a great book for people just trying to understand the lexicon of New York City real estate or commercial real estate. And then from a sales perspective, I've read a bunch of Jeb Blunt's, I think that's how you say it, Jeb Blunt's books, and really enjoy those.
Amazing. By the way, the Sam Zell one, honestly, that's like, get that one. Am I Being Too Subtle? Is amazing. It's so good. And listen to an audiobook. He actually reads it,
Oh, really? I didn't know that.
So good. So rich. Question number 3. What are you most curious about right now?
Honestly, maybe deferred sales trust. But I think what I'm most curious about right now is trying to understand more so what the evolution of industrial real estate is going to be. Because we've been dwindling real estate supply, and then also you're starting to see some industrial buildings in certain neighborhoods trade more like destination retail. So I'm really passionate about industrial real estate in Brooklyn. I'm always thinking about it, always trying to get smarter on it. And so the future of that asset type, while it's directly tied to my career, I'm really interested in understanding more about it and future trends and positioning myself in the best way. So I would say that's probably what I'm most curious on right now.
Awesome. Last question as we wrap it up, Bobby. After all your success, helping a lot of people create and preserve more wealth with real estate and industrial real estate and multifamily from the past, how do you best stay centered in your values, and how do you stay encouraged to charge forward to reach even higher heights?
I think in terms of, how I stay centered is, realizing that bad things are going to happen. Deals are going to die. And obviously that sucks. I mean, a lot of the times you can let that ruin your day or ruin your week. But I think especially through these past few years, especially in New York City real estate, we had COVID, we had interest rates, we had some terrible legislation. I've learned that kind of keeping even calm or, kind of even keel, is the best way to operate, not only for myself mentally, but also for my clients. And I've really kind of dove into that through kind of providing or instilling that mindset in myself. And then what was the second part of the question? Sorry.
Oh, that's it. No, you nailed it. You nailed it, Bobby. Like just staying centered and staying encouraged to charge forward is keeping the right mindset, right? And realizing that tough things are going to happen, right? And not letting that derail you week to week. So no matter what the outside circumstances are, just focus on what you can control. So you nailed it, Bobby. I want to thank you for being on the show. This has been awesome, man. I appreciate your expertise to your craft and your passion for helping owners of industrial Brooklyn real estate create and preserve more wealth, unlock the freedoms they're looking to unlock, and ultimately help them create and preserve more wealth for themselves and their family. I want to encourage you to keep being a great listener, which you were today as well. especially on the deferred sales trust. And I'd love the opportunity to work with you to help your clients on that and anyone else listening. And so, Bobby, for those who want to get in touch with you, what's one last time, what's the best place for them to find you?
Shoot me a call or text at 908-616-5799. I will, if I don't answer right away, I will give you a call back probably within 30 minutes, unless I'm in a meeting. It's probably the best way to reach me.
Awesome. Bobby, Lawrence, thank you so much. And I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. Also, we're streaming on Expert CRE Secrets podcast as well, and YouTube channels for all our commercial real estate experts or investors out there. Thank you for listening. I think you hopefully gained a lot of value today from Bobby in ways to build wealth, 1031 exchanges, deferred sales trust. We believe that most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, also death tax options, right? And not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust, also 1031 exchanges when appropriate, are amazing ways for you to create and preserve more wealth. If you want to learn more about the deferred sales trust and what your options are, just go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. Also check out the best 1031 exit plan that just got released on experttaxsecrets.com that gives you the option to do a 1031 exchange, as well as a Delaware statutory trust and a deferred sales trust. Have all three options just in case your deal doesn't work out. We can save a failing 1031 exchange, but have the confidence to go and find a deal in case it doesn't. And then the deferred sales trust to fall into like a parachute, just in case it doesn't work out. Go to experttaxsecrets.com. Thanks so much for listening, everybody. And we will